You know, it's a rather spotty bio I've got because I tend to get bored very easily. So I just keep doing new things and always get entertained by doing them. And what the result of that is what I'm talking about today is I spent 15 years as a CEO of a company and exited that thinking, oh, you know, we created a mid-range company. We were profitable, we were growing, but we weren't a world-class success. And I didn't know how to create a world-class success. So I said, well, I better figure out how to do that. So I went around trying to work at a variety of companies that might become world-class, and none of them did. I worked in investment banking to see if I could see companies that way, because you could see lots in a year. I worked in venture capital for the same thing. I worked at Mars, which is a regional innovation network you might have heard of in Toronto. All of that trying to see whether I could find a formula for success that I could then apply to another company. And the problem was, in that whole time, I didn't encounter a single one company that went on to become world-class. Some say that there's a correlation between me being involved in the company and whether it gets to world-class, but I'll deny that right now. Certainly it's not causal, at least I can claim that until proven otherwise. But I got lucky and ended up at U of T and spent 7 years doing research. And it's that research which has really gotten me to understand in a completely different way what it is that causes companies to be able to scale and other companies not to. And in the process, I've looked at thousands of companies, literally. I meet with hundreds of companies a year to figure out what they're doing. I keep data on thousands of companies, and for this talk, Simon asked me to look at the West. And so I took a look at what's going on in Western Canada amongst scaling companies. Now, to put this in perspective, I put a line when I say companies start scaling. And in reality, the line is somewhere different, but for the sake of doing research, I put a line as any company that has raised more than $10 million is in the process of scaling. I have to put the line somewhere, and it's an arbitrary line. I could put a line in people, but the data is easier to get when I'm putting the line in capital. When you look at it, there are 17,000 companies in the United States that are scaling, that have got more than $10 million of capital, and somewhere around 800 in Canada. So we're already dealing at a bit of a disadvantage when we're looking at that. And I looked at those, and I do those, look at the Canadian companies every year as part of the Narwhal list. I went and looked at the ones from the West, and there were about 160 I could get data on and be able to look at. And the data that I got was from Crunchbase and LinkedIn. So I use the data on capital, on employee size, and I use employee growth as a proxy for revenue growth. Because for heaven's sakes, I can't get 17,000 companies to tell me how much they grew last year. In fact, I've tried to get companies to tell me how much they grew. And if you remember, I asked the panel this morning how much they grew, and only one person actually told me how much they grew. Nobody wants to report that. I don't know, it's embarrassment, or it's like disclosing how much money you made last year, but nobody will tell you. So I've used proxies, and I get a chance to test the proxies on a regular basis, so I'm pretty happy with it. So the first question is, how are we doing as a country at scaling? Well, of course, my slides aren't up there. I didn't even notice that, sorry. Too worried about swiveling around to talk to everybody. Okay. Oh, left to right, okay. So, let's start first and talk about productivity. You might have noticed that we had an economist this morning talking briefly about productivity. Now, unfortunately, and I can tell you the same message, our productivity growth is subpar. And you can see there's a little gold line in there, the third to last. And that's Canada compared to all sorts of other good countries in how we're doing it at growing productivity. It's a problem that has existed for at least 75 years. And in fact, I often start speeches with an article from the Globe and Mail saying Canada introduces 2 new R&D programs because we suck at productivity. Sucking is an economic term, by the way. It's just so that you know I'm not using it inappropriately. So 75 years we've been doing basically the same thing, and we've been looking at R&D. And what you got this morning was part of the reason why we are challenged at productivity, is that the definition that the government and EDC uses looks at one factor in driving productivity growth and not what I believe is the better factor. They look primarily at what he said this morning was ways in which people are investing to improve their production. So you can improve productivity because productivity is output per hour of work. You can improve productivity by lowering costs, making people be able to produce more, or you can improve productivity by introducing new products into the market and expanding your revenue. Unfortunately, most of what the government looks at and most of the problems they deal with are expanding productivity by lowering costs instead of expanding productivity by increasing revenue. And if you look at what the United States is good at, what are they good at? They are really good at new products in new markets and growing like absolute stink, taking over, doing things that no one's ever done before. If you look at all of their technology firms, they didn't become productive by saving costs. They became productive by finding markets and going into markets that were radically different with much better products. So when we look at productivity, we're looking at it from a lens that misses half of the opportunity. So how are we doing compared to the US? Well, one way of looking at productivity is through growth. In here, I've got North America on the left-hand side, and average growth in North America, including Canada, in these companies that I studied annually this year was about 8%, scaling companies. It's a lot lower growth than you might imagine because most scaling companies are not succeeding at hyper-normal growth. Canada has got somewhere just over 4% growth in its companies, and included in that is the West, which is in red in all my graphs from now on, just slightly below Canada. And on many regards, the West is symptomatic of Canada as a whole. It isn't doing worse or doing better than Eastern Canada. They're about on par. I think we're facing many of the same challenges. The thing about growth, and this was interesting as well in this morning's conversation, is that in a different conversation, the individual who phoned in from the Netherlands was talking about differentiating between scale-ups and exponential growth companies. And the differential that he made said that scale-ups are companies that are trying to grow revenue faster than costs, where exponential growth companies aren't as concerned about costs. So the idea being scale-ups are more profit-oriented. But in actual fact, you create world-class companies by ignoring profits. And virtually every single company that you can see out there that has become exceptionally large, Amazon's the best example of it, has become large by just caring about growth. The markets value growth because growth drives valuation and it drives capital availability. And the faster you're growing, the more capital you get, and the more capital you get, the faster you grow. 92% of the software companies that go public are losing money. And average losses amongst those companies is greater than 30% of revenue. It doesn't matter. So if we want to differentiate between scale-up and exponential growth, I don't really care, because what I care about is creating world-class companies. What does it take to create an enormous world-class company like Shopify versus an also-ran company that might exist in Canada and nowhere else? And whether they're scaling up through profits or anything, it really doesn't matter. What matters is this exponential growth. And the thing about it is there's a lot of recent economic research that is showing that the countries that are more productive are becoming more productive because of their tech industry and because of rapidly high-growing technology companies. And it's a part of the research that's really interesting, and it is to me because what I've looked at over a number of years is the relationship between large firms in a country and how good productivity is. And it is my claim that the more large firms exist in a country, the higher the degree of productivity. And you can show that in the data. The problem is Canada does not grow large firms. We are a country of mid-sized companies. We're a country of small to mid-sized companies. Large companies are by nature more productive. They have higher revenue per hour worked than small companies, and the more big companies you have, the more productive you are. Canada's challenge, doesn't matter whether it's scaling companies or high growth, is to create world-class companies of enormous size that can then drive productivity. So it's a different nature of a problem. Instead of trying to save costs, let's try and build bigger companies. And I want to look today at how we're doing in the West, what problems we might be having, and what we can do about it. So, how is the West doing at scaling up? What I measure here is, by city, the number of scale-ups per million population. What you'll notice is in the top, and this is by location in the country, from west to east, all the way down, is that Toronto, as one might expect, leads Canada at the number of scale-ups per million population. And no surprise, Vancouver's second and Montreal's third. For the most part, you can see this relationship occurring time and time again, in that the concentration of population is more likely to create scale-ups. So a bigger population, the more likely we have of bringing scale-ups to bear. Now, San Francisco beats that in terms of numbers, but when you look at the US, there are 7 economic zones in the US with more than 30 million people. In Canada, there isn't one. The biggest economic zone is 16 million people in Ontario. And so by nature, you would expect a lower degree of competitiveness, a lower degree of requirement for strategic capabilities because of lower competitiveness, because of lower population, and they all come together to create fewer opportunities for world-class companies just by virtue of the population size and the dynamics of the economy in each place. And so when you look at this graph, it looks like it makes sense in that regard, in that Calgary, which is a bit smaller than Vancouver, isn't doing as well. Montreal is number 3. Kitchener-Waterloo is the oddball in this list. It's sort of like the San Francisco, and it's the oddball because of the implosion of BlackBerry a number of years ago, which spun off a whole bunch of companies that wouldn't have existed otherwise. So Edmonton is trying to succeed, a bit ahead of Mississauga, but another fact is you can compare each of these cities to what's going on in North America as a whole. And so what I look at is I compute a metric that judges how Canadian companies are doing compared to all companies in North America. And then I average them for a city. So the percentage you see there is at what level scale up we're creating. So Vancouver companies are scaling at about the same average rate as all North American companies. Toronto, Mississauga's a bit better, Toronto's a bit less. So Vancouver's actually doing quite well. And as you can see though, Calgary and Edmonton, the companies that are coming out of Calgary and Edmonton are not scaling as fast as the companies that are coming out of Vancouver, Toronto, and they're not scaling as fast as the companies that are coming out of the US. Tracking these over time, which I've done, allows you to figure out what's going on in a place and what are the factors that are driving performance. One of the factors in Calgary, as I understand from conversations, is it's a fairly new economy at scaling up, in that there haven't been a lot of large firms that have been around for a while to be able to spin out success stories. And it's the spinning out from success stories that often creates the companies. Shopify is right now spinning out all sorts of success stories. Nortel never did, oddly enough. BlackBerry spun out a lot. When you look at San Francisco, all you see is spin out people. People who've worked in one of the big places going on to start something else. So it's a bubbling up of the economy that occurs when you get a successful company. So it'll take a bit of while before Calgary and Edmonton get up to the same degree, but they'll only get there if they fight against the problem that they have in that the local companies don't provide the impetus for success. The next chart is something really interesting, and it shows how companies are doing the 2-year employment growth in scale-ups as a whole in a particular city. And there, Edmonton is doing phenomenally well. What I think has happened is that Edmonton is coming into its own, and a number of companies in Edmonton are getting to the stage where they are scaling finally, and so you're getting an extra normal growth in scale-up employment in Edmonton. Vancouver, not doing as well. This is sort of the inverse of the other graph, in that it's showing that the more companies you get going into the scaling process, the greater the growth in employment. So it should be one of the objectives of a region is to create these scale-ups, because the creation of the scale-ups creates the growth that you're getting to. Kitchener-Waterloo gets blacked out because I'm very bad at doing charts. Very dramatic loss in the number of scale-ups. They, a number of years ago, stopped focusing on the bottom of the market, the startups, started trying to focus on the scale-ups. That doesn't necessarily work. And in doing that, they stopped creating many companies, and so there are fewer scaling up now, and so the scale-up world in Kitchener-Waterloo is getting old, and it's getting stale. It's becoming vibrant in places like Edmonton, and oddly enough, vibrant in places like Quebec City. It's really interesting to see different regions behaving differently in this regard. Quebec City does a particularly good job because they have a number of programs that are export-oriented. Another factor is the amount of capital that's available to the scale-ups in a region. And as you might imagine, Mississauga does well because there are a number of life sciences companies there that are getting lots of money, but it's more of an outlier. Toronto is well-financed, Kitchener-Waterloo, Vancouver, but then again, Calgary and Edmonton. Now, people look at this and they say, well, we need more capital in Edmonton and Calgary. It's the natural reaction. And in fact, if you ask entrepreneurs what they need, they'll say, well, we need more capital. It's always the answer. I don't think that's the right answer. I think the answer is we need better companies. And if we create better companies, the capital will follow. I worked for a number of years in the country of Colombia, and they sounded just like Canadians. You'd think we taught them how to complain, because they kept saying, oh yeah, we don't have any venture capitalists, we don't get any money, we'll never create big companies. Well, the country of Colombia created 2 unicorns before Canada did, because they happened to have one company, Rappi, which was a last mile delivery company, similar to Uni Uni in Vancouver, but a predecessor to Uni Uni, that became remarkably successful. And all the capital flowed into Colombia, because the one thing the venture capitalists are good at doing is funding companies that are growing like stink. But they don't fund companies that aren't growing like stink. So it's the company that comes first, not the capital. It's not the capital that's creating growth, it's the company that's having growth that brings in the capital. And that's a unique relationship that a lot of people, when they're trying to raise capital, don't particularly understand. They think, well, you know, we grew 22% last year. If only we had $10 million, we'd be able to grow 37%. Doesn't work that way. It doesn't even work if you're growing 37%. You have to be growing at 70%. If you're growing at 70%, people throw money at you. If you're growing at 22%, they will ignore you. So that's one of the factors of capital acquisition, is it goes to the ones who manage to figure out how to drive success. And there's steadily more amounts of capital available for those companies. So when you look at $1 million per scale-up, it's a bit of a misnomer. It isn't that Calgary and Edmonton need more financing. It's that Calgary and Edmonton companies need to do better in order to be able to drive capital into the area. And what happens here, and this is an interesting graph, is this shows the amount of average funding received per month since the company's existence in the US versus Canada. So if you look at this, by the time a firm is, and I can't see, is that Series A? Yeah, by the time a firm is Series A in Canada, when I did this, the average funding per month was $300,000. In the US, it was $550,000. So let's do a little mind game here. The mind game is that you're an entrepreneur and I give you $2 million because you're in Calgary, versus you're in San Francisco and I give you $6 million. So you go out and you build a product, and maybe building the product costs $1 million. And you go out in San Francisco and you build a product, and maybe it costs you $1.5 million to build the product because they don't have shreds. And we've got shreds, and they're deemed to be the best program known to mankind. But the Calgary company has $1 million for sales and marketing. The San Francisco company has $4.5 million. Who's going to win? The San Francisco company will be in front of more companies and more often than the Calgary company, and as a result, they'll get more buyers. It was another thing that they complained about in Colombia, and I keep bringing them up because they're such a marvelous comparison. They used to complain that even their biggest companies weren't buying from Colombian software vendors. I said, so tell me about the sales process. And well, we go in and we make a sales pitch and blah, blah, blah. And I said, oh, sorry, how many people do you send in? Well, we send in one. And how often do they go into these companies? Well, we go in once a quarter. I said, and your American competitors who are winning all of these deals, how many people do they send in to make a sales call to a bank or to an airline? Oh, well, they've got lots of money. They send in 5 or 10 people. And how often do they send them in? Well, they send them in weekly. And the real comparison there was that the dollars in sales and marketing is a cudgel that people can use to be able to beat the competition. And the Americans are particularly adept at doing that. There's an interesting piece of research I did a number of years ago that showed that there's a really high degree of correlation, in fact, about 0.58, between how much a company raises in its first round and how far it's able to get in the next 5 years. And in fact, if you look at the top quartile companies, all of the IPOs come from the ones that raised the most amount in their first round of funding. Because you get onto a virtuous circle. And the virtuous circle starts with some growth that raises capital, that gets more growth, that gets more capital, and you become part of a tier. And the top tier companies are raising phenomenal amounts of money, like Cement at $140 million. And the bottom tier companies are raising $1.4 million. Who's going to get farther? It is a function of capital, but it's a function of the company itself and its ability to get capital that gets that. So our companies have too little capital at early stages. And what happens is when you have too little capital at early stages is that later on in life, you're on path low. And path low grows companies at 30 to 40% a year, maybe 50% a year. When you're growing at 40 to 50% a year, you'll get local capital, but you won't get foreign capital. And what happens is that local capital runs out after a Series A. There aren't players in Canada, for the most part, investing in Series B capital. So Canadian companies are growing too slowly by the time it comes to Series B capital, and as a result, very few companies in Canada get Series B financing. In fact, in this study I did, and this is an annual study, this is the class of 2014, 8.4% of Canadian companies got to Series B. You'll notice that the West did better than the rest of Canada. So there isn't a problem in the West versus the rest. The West is actually doing quite fine. But if you compare to the USA, which 13.9% of their companies get to Series B, Germany, 19.2%. Canada is last at getting companies to Series B amongst major countries. And because we don't get many companies to Series B, we end up creating even fewer unicorns. The ones that get Series B get US Series B money, and then that money goes on to create potentially unicorns, but we're creating fewer of those unicorns because of it. So you can measure unicorns per million population as a good measurement, because we got to get around the issues of size of countries and things. You'll see that the US is creating 2.3 unicorns per million population. Canada's down at 0.65. The West, once again, is doing better than the rest of Canada at 0.68. It's not materially better, though. There's nothing you can tease out. The ones to really watch in this are Singapore. How does a nation of 5 million people produce so many unicorns? It's phenomenal, and I don't know the answer to that, and I have to figure it out. Israel's another country to look at. So we don't necessarily need to compare ourselves to the US, what we're doing there. And the biggest problem is that very few of our unicorns exit. So there have been about 1,750 unicorns created in the US ever, and about 35 in Canada ever. Of those 1,750, 738 actually, did I get the number right? 738 actually exited through an M&A event, an IPO, or a SPAC. Canada? It doesn't even show up. I couldn't even color the line because the line was too small to format. 3. The West? 1. Now, I've gone and given you credit for Benevity. Benevity was actually never a unicorn. They only became one when they sold, which doesn't qualify them to really be in a unicorn. But I knew I was going to get such hassle from people in the crowd that I included Benevity. So yes, you have created one. Toronto hasn't created a successful unicorn yet. Of those other 2, Nuvei was one, which comes out of Newfoundland, and they successfully IPO'd and then got sold, billions of dollars. For Newfoundland. Who's giving capital to Newfoundland? Nobody. Capital goes after good companies, right? The other one was Coveo. I can't remember where Coveo was located, but it went public on the Toronto Stock Exchange, which really doesn't qualify because it's a junior exchange when in the world you can't use shares on the Toronto Stock Exchange to buy American companies. And Coveo declined so much that their stock is now worth much less than people invested in the company in the first place. So it's a failure. So we have this funnel problem. The top end of the funnel is anemic in success stories, which means that venture capitalists are failing, and over the next few years will fail by the dozens in Canada because they're not getting exits to replenish their funds to pay back their investors to get new investors. But there is something that's working in Canada, and this was accidental research. I looked at the number, the top companies by the number of foreign funders they had. So this is 800 companies or so. The companies that had 5 foreign funders were growing twice as fast as the company with 0 foreign funders. And it's a straight line from there up. So something's working. Canadian companies that get foreign funding do better than Canadian companies that don't get foreign funding. And why is that? Because foreign funders know what to invest in. They know not to invest in a company growing at 22%. They know to invest in companies that are growing at 70 to 80%. They respond faster. I have my own personal experience with that, which blows my mind at how fast the foreign VCs respond compared to Canadians. And they provide more help later on. So all of that propels twice the growth rate. But even then, at the top of our unicorn funnel, we have a problem. Because of the 20 some odd companies up there, there are only 5 that are actually performing properly. But our scale-up funnel in the East and the West is broken at the top. But the company problems are starting at the bottom. So the government has been spending its time trying to solve the scale-up problem by focusing on scale-ups. By then it's too late. Solving the problem starts at the very beginning. And I want to show you what's going on. Why is this happening? And this is becoming the new Canadian angst, which is why we're having this discussion today. What's happening in the scale-up industry in Canada? No matter how much you hear from the government, growth does not come from R&D spending. Canadians spend more on R&D than Americans, and we grow slower. If growth were as a result of R&D spending, then we'd be growing faster. And frankly, I've never sat in a business meeting and found the answer to the question, how do we grow more, to be, let's do more R&D. It's always, let's do more sales and marketing. Let's go into new markets. But we tend to focus on R&D. We also focus on taking out patents. And I blame Jim Balsillie for this, because he has this fixation on patents that knows no bounds. And he manages to convince the country to put patent programs in place when we don't need any. Because in fact, you can see from this graph, I looked at computer tech, health tech, and clean tech companies, a greater percentage of Canadian companies patent than American companies. And when you look at the amount of capital per patent, Canadian companies patent more per $1 million of capital than the American companies. We are patenting more than American companies, and we're patenting in the States, and that's not driving our success. Because success has nothing to do with R&D and shreds and patents or accounting for that matter. Here are the reasons. Slower growth is partially due to the markets we enter. And I'm going to use Western data to show you this. And I was so happy when the data came out the way I wanted. And that's not because I cheated at data. It's the way it happened, luckily. The bigger the market, the faster the growth. And this is something that is, oh yeah, logically, is anybody nodding their heads? Uber. Uber went from 0 to $14 billion in revenue in 10 years. Why'd they do that? Because their market is $2.5 trillion. Dropbox went from 0 to $1.1 billion in about 11 years. Their market was $50 billion. And in fact, I lined up all the software companies and found that on average, successful companies get to 0.85% of their market by the time they go public. 0.85%, that's less than 1%. Uber got to 0.45% of its market when it went public. The bigger the market, the faster the growth, because a market does not grow, does not reach saturation faster just because it's small. They take on average a generation to reach saturation in a market. So if you've got a small market, you've got a generation to get to that market. If you've got a large market, the same thing. Where's your growth going to be? It's where the curve ticks up in the larger markets. So one of the requirements for success is to be in large markets. Now, here's a problem. In Canada, only 30% of Western companies enter horizontal markets. Just 30%. Horizontal markets are on average 7 times larger than vertical markets. So what's the growth rate going to be in a horizontal versus a vertical market? It's going to be much better. Now, oddly enough, I was invited out to dinner last night by Ray, and he brought a few friends of his along. And I think there were 6 people there last night. They are all successful scale-ups. And 7 people, 6 of them were in horizontal markets. One was in a market I couldn't understand whether it was vertical or horizontal. But it was absolutely amazing when I went around and looked at the crowd. Why was I standing next to successful scale-ups and they were all in horizontal markets? It's because that's where the growth is. And then on one of those moments of sheer serendipity, I was doing the research on this and I thought, well, let me divide. So I looked at every one of the 160 companies and I said, okay, I divided them between horizontal and vertical markets. And I said, how many employees are in each of them? And the graph turned out perfectly. The average horizontal company in Western Canada has 213 employees. And the average vertical market one has 88. There's nothing that could be clearer about this result. Horizontal companies serving horizontal markets grow faster than companies serving vertical markets. But you know what we as a group do? And I've heard advisors say this, I've heard VCs say it. They discourage people from entering horizontal markets because it's riskier. Fundamentally, though, we're better off in horizontal markets. And we have to encourage companies to get there instead of staying in vertical ones.
Charles, could you just explain the difference between a horizontal and a vertical market for us?
Sure. Jory sells software to all mid-market type companies, SAP software. That's a horizontal market. If he sold only to legal entities or only to manufacturers, that would be a vertical market. Good enough?
That's good enough.
Good. So it's an amazing result when you line that up like this and find that, yeah, you're 3 times better off to be in a horizontal and a vertical market, but we discourage companies from being there. The next thing is 90% of Western companies enter B2B markets. 90%. But consumer markets are larger than B2B markets. I defy anybody, go on Wikipedia and look at the list of the world's top technology companies and tell me what markets they're serving. The top technology companies are all serving consumer markets. And as you go down the list, eventually you'll get ones like SAP that are serving consumer markets. Eventually you'll get ones that are serving just B2B. If you look at software, the top software companies are serving consumer markets, and they are about 5 times the size of the top B2B market companies. And you know what we do as a country? We discourage people from entering consumer markets. Actively discourage them. So we are actively discouraging people from doing things that make them successful. Western companies in horizontal consumer markets are growing 37% faster than other companies. And I love it again when the research comes out exactly with what I'm expecting. So it's only 6% of the companies because we're actively discouraging companies from being horizontal and consumer-oriented. Another factor is, and this is another thing we do, is we encourage companies to start selling in Canada. You know, sell where the lowest hanging fruit is. But Canadian market is small, and it buys in a strange way, much slower than Americans. You heard that out of Cement today. You heard that out of a number of people. So the way Canadians buy and the speed in which they buy is really slow. So when companies start out by selling in Canada, they are dooming themselves to a low track of growth. They're dooming themselves because by being there, they aren't getting the growth that they would get if they went to the US first. Our companies have to be born global, and yet we discourage them from being born global. Companies are also having difficulty in transitioning from founder-led sales because they skip marketing. A number of companies I've talked to have said, oh yeah, I tried to grow, I hired a few salespeople, it didn't work out, I had to fire them. It's astounding, the number that have said that. The reason is, they don't start by figuring out what their market is, they don't start out by developing content, by doing lead generation, and filling the funnel before they start selling. It's a fundamental misunderstanding of the world of marketing that gets us there. We're not spending enough on M&S. This is us versus the US. We spend about 35% on revenue on marketing and sales. The US spends 47%. The companies that start spending on marketing and sales as much as R&D from the minute they start do better from the ones who wait. Have you noticed the theme here? What's it all relate to? Markets, marketing, and sales. And finally, leadership teams, and this was another really funny one. I went and looked at the leadership teams of each of the 160 companies. This is a lot of work, actually, to figure out what their backgrounds were and what they were doing. And you'll see from that, almost all of these companies have a CTO or a VP of engineering. Very few have a CMO or a VP of marketing. A lot of them have a VP of finance or CFO, and the reason for that is that their investors tell them they have to have a CFO, but the investors never say, oh, well, you have to have a CMO. The investors say, oh no, you have to have a CFO. So there are more finance people who are relevant to growth than there are sales or marketing people. Now, of course, 38% of Western scale-ups have no senior marketing or salesperson. It blew me away. 38% have no one senior in a whole discipline. How could that occur? Because we believe that the technology will win and don't believe that marketing and sales have anything to do with it. But here's a lovely chart. The ones with at least one senior marketing and salesperson have an average growth of 5.6%, and the ones with none, 1.7. The ones with marketing and salespeople have 229% faster growth. Astounding opportunity for improving companies in a number of ways. So, how can we improve the West performance? I'll get to this slide in a second. But number one, we've got to start companies globally, not locally. We have to get them making research calls and sales calls in global markets before they do it in Canadian markets. We need them to focus more on marketing and sales because it's marketing and sales that drive growth, which drives the creation of world-class enterprises and will eventually drive growth in Canada's productivity. Scale-ups must hire more senior marketing and salespeople. And it's easy to spot these problems occurring. Very, very easy. And startups need to go after bigger markets, and frankly, most of them measure total addressable market incorrectly. And as a result, they think they're in a big market when they really aren't. And there's a whole, I could go on and on that forever. Both startups and scale-ups must spend more on marketing and sales. Now, I had an interesting dinner last night because around the table, everybody was singing from the same song sheet. They all would say these things, and then I'd give them the percentage that applied to it. They all knew what it was to be successful. They were in horizontal markets. They had senior marketing and salespeople. They spent a lot on marketing and sales. They were export-oriented. They were all doing the right things. So there are people in the market that are doing the right things. But that knowledge is lost. And the knowledge isn't getting down to the startups because there's no coordinated way of getting it there. So the knowledge is in the community, and I face this in Eastern Canada as well. Somewhere in the middle, by VCs and by organizations that are supporting startups, startups are being discouraged from doing the things that will create world-class companies. We need to get together, and I put on one slide government. We don't need the government to do this. We need ourselves as organizations and as people serving the community to get singing on the song sheet. I saw it occur in Colombia over 5 years, and it was really interesting, the different change in culture that moved from an R&D-oriented culture to a marketing and sales-oriented culture in 5 years across a whole country. And I met thousands of people over those 5 years, and so really got a sense of what was happening. We need to do that. You need to do that out west. I need to do that out east. Somehow involve everybody in the process of singing on a new song sheet. Because it is possible to produce these companies. We are producing some of them. And if you look at the ones that we're producing, they have these attributes. So the question I leave with you, is anybody going to do anything about this? How can the West come together without the use of government? We don't need government programs. We need attitudinal change. And that's it.
So I'm going to take a little bit of Chad's time, 5 minutes or so, just for some Q&A. So questions in the audience, and I've got Vancouver and Edmonton also coming in with questions. But who would like to address any questions from what Charles has just shared? Do you agree, disagree? Do you have other views?
Thank you for the presentation. Now, you discussed heavily on technology companies. In your data, is there a company that has been successfully scaling up and is not a technology-driven company?
Is not a technology company? I tend to study technology companies, but the same things matter for non-technology companies. I met somebody who paints lines on parking lots for a living at lunch today, and that was an amazing conversation because he's been successful by franchising, which is a function of getting the salespeople locally, basically, and people really dedicated to it. So I haven't done the research, but from experience, all the same things apply.
Over here.
Charles, thank you so much for the statistics. That was fantastic. Maximo Tenosov, I run a small private equity company called Future Ventures. I'm curious, from your Colombia experience or other international experience, what are other countries doing to keep the top of the funnel full with great companies, and should Canada adopt some of those strategies like in Chile or Argentina or Colombia, where they're paying companies to move there and be part of the ecosystem?
They're not doing a good job. No, the U.S. is the only place that's really doing a good job, and Singapore and maybe Israel. It's the only place where that's really happening. I think Singapore, you have to be born global. Israel, you have to be born global. The US, you don't have to be born global because you've got a population of 350 million people, so you can create a world-class company without ever leaving the US. But any other country in the world has to leave its country to become world-class. And all of us countries that have to do that are struggling at it, except for Singapore and Israel.
Hey, Charles. This morning, Brad Perry, the CEO of Calgary Economic Development, talked about how our startup system, like in Calgary, maybe with the West, has grown from 2 billion to 8 billion. However, we're not seeing lots of these scale-ups and all of that stuff. In your view, do you think something is fundamentally wrong? Because it's like the base is growing. You think about, there was the graph you showed, was it Kitchener? Where they focused on scale-up, but however, all the startup, there was nothing happening. What do you think about that picture for going from 2 billion, 8 billion, but however, not enough scale-ups?
Well, you do need the base, but you have to have the right type of base. And the problem out west and in the east is that the base isn't there because companies are after vertical applications in the software industry or small market companies, partially because there isn't the exposure in Canada amongst entrepreneurs to big markets natively. And so we really have to concentrate on that because we will continue to create small vertical companies, because when you have a vertical company, there's only so far it will get. And your research about companies stalling, Peter, part of that stalling is they reach saturation in their market. And it's possible to measure that. They're also reaching, saturation in a sector of the market in which they have a competitive advantage or product market fit or something like that. So in every case where I've seen a stalled company, I've been able to figure out why it was stalled, and it was always related to sales and marketing.
Did you factor in the tax environment of the countries that you looked at, excluding SR and ED credits for Canada, which I recognize as an advantage, but isn't that why Singapore is because of the tax laws?
No, I ignore tax. I'm a CA, and I think it has nothing to do with anything. I've been claiming SR&ED since the first year of the program. Personally did the SR&ED filings myself, and I was in companies that did it before SR&EDs, because I date back to the 70s. So, it's just a nothing. The tax regime doesn't, the government's plan to raise capital gains tax to 66, it wouldn't have mattered a bit. Seriously, you just ignore it. The unfortunate part is that by giving money to SR&EDs, what you create is zombie companies, because companies don't have enough to spend on sales and marketing, but they have enough to spend on R&D because they get SR&ED money back. So we have these zombie companies, tons of them out there, that are all doing a lot of R&D but not getting anywhere. So it's distorting the economy. It's also distorting it because more than half of SR&EDs goes to lowering costs instead of increasing product sales. There's a program, $5 billion, $4 billion a year, and they've never had a review of the program, ever. What's with that?
Last question in our room, and then we're going to go to Edmonton and Vancouver.
Hi, Charles. You ended your comments with, we need to change attitudes. So the loaded question is, how do we do that? How do we do this attitudinal change that you refer to?
It's every time you meet a company that's going vertical or B2B, you say, well, you have this conversation. Let's look at your strategy. It's taking companies because they don't know. And, teaching somebody, you need 7 attempts to teach them something. You're going to walk out of here, and 2 days from now, you're going to say, what was it that Charles said after all? I know he said something, but I can't remember what it was. I have to repeat something 7 times for people to get it. You're going to have to repeat it 7 times, and everybody has to be singing on the same song sheet. The local VCs, the local development organizations, the senior people all have to be giving the same advice. If you want a world-class company, here is the way you do it. One way of doing it is creating a playbook. You've got a RIN market. How long have the RINs been around here? How many years? 18? You know, I've been associated with the RIN network in Ontario since 2007. Not a single one of them has a playbook that says here's what works and here's what doesn't work. Not a single one of them has done any research to say here are all of our companies that have come through and here's what's worked and here's what hasn't worked. Not a single one. I associated with a whole bunch of angel firms, and I have been an angel. Not a single angel group I know has done any research to determine what their return rates are and how to generate better return rates. We are amateurs. We aren't professionals. We're treating this like amateurs. We're not playing Moneyball. Has anybody seen the movie? All I'm doing is playing Moneyball. Go home and watch the movie Moneyball and think, how does that apply to the community in the West? How does that apply to our high growth community? How can we play Moneyball? The US is playing it.
So the question from Vancouver and Edmonton is related to you explaining that companies in Canada need to go outside of Canada for their markets first. How does that get balanced with potentially establish themselves in Canadian markets? Do you think it's important to do that or not?
I don't think you need to make a single sale ever in Canada. Canada is 2% of the world's buying market. Who cares if you have 50% of 2%? Nobody cares. It's not going to propel growth. You're much better off going anywhere else. It's, you know, all of the people in the health tech market are slowed down by having to get Canadian regulatory approval. Ignore it. Don't bother getting Canadian regulatory approval. It's a great place to develop a company. It's a great country. Do the R&D here. Do the accounting here. Do the sales and marketing elsewhere. That's what the Israelis know really well. First thing they do when they start a company, they open an office in Boston for sales and marketing.
I think it's a really valuable and important insight. You know, one of the organizations supporting Scale Up Week is Zayzoon. And if you look at Zayzoon's sort of story, they started in Canada, tried to secure clients and couldn't, and got pushed to go to the US.
Yeah.
And then that led to raising capital and all the rest of it, you know, and the story is the rest of it's history, really. Now they're re-entering Canada, but only once they've got to a size and a certain level of clout that they have the ability to invest in marketing and sales to the extent that they would need to be here. But at the early stages, they were unable to do that, to capitalize on the market. So I think it's a really interesting story in terms of the directions that you choose to approach the markets from. So,
but the best they can do is, you know, get 10% of the US results. Frankly, who cares? That's, you know, it's such a distraction to try and enter a country. Better to go to Brazil, big market. Better to go to the UK, go to somewhere in Europe, go to Kenya. Lots bigger markets.
well, thank you, Charles. We've run out of time for questions now, but I'd like us just to show our appreciation for Charles and what he had to share.